Hello, everyone. It's Whitney Emmanuel with Strategic Visionaries. I hope you are doing splendid today, and just wanted to hit off your day with some tips. And today's tip will be about the tax treatment of your assets and your investments. It will range from real estate all the way to your IRAs and 401ks. And this is a question that a lot of my clients have, so I hope that you find it beneficial. Keep in mind, I'm not an accountant or a CPA, so I can't give tax advice, but I do discuss tax strategy with my clients. So when you think about tax treatment of your investments, you need to think about, number one, how are they being taxed on the front end? Number two, how are they taxed on an ongoing basis? And number three, how are they taxed on the back end when you withdraw the money or when you sell something? And so in the first category, and we have three categories for how things are taxed. So number one, we've got tax deductibles. So these include qualified plans such as your 401k or 403b through work, or an IRA that you may start for yourself, or a SEP IRA or a simple IRA if you're a business owner. So with this, you put the money in and it's a tax deduction. So let's say you made $100,000 and you put $5,000 into one of these accounts. On taxes, it shows that you made $5,000 less. You're at $95,000. And that's a front end write-off. As the money grows, it grows tax free. So no taxes are being withheld, or none of the earnings are being taxed as it grows. But when you do take that money out, 100% of your withdrawal will be income taxable. And these accounts typically have a rule that you have to wait until you are 59 and a half to withdraw that money without a penalty. But you always have to pay 100% income tax on the withdrawal. So that's the first one, tax deductible. Number two, taxable. So this is not a tax shelter category at all. It's just any investments that you decide that you want to do. So that could be maybe stocks, it could be mutual funds, it could be property, it could be even just your business, a side business where you earn income. So when you put money into this type of asset, it's already been taxed. It's your take-home pay. Then as the money is growing in these, you are taxed on any income or dividends. So let's say it's rental property and you bought it for $100,000 and you get $100 a month in rental income. That shows up as taxable income to you. And even as that property is appreciating, you're not being taxed on the growth of that value, but you are being taxed on any income that you realize. True for stock dividends, true from income from your business, less write-offs, and that's where you need to consult with an accountant. And then when you decide to sell that property or that business or that stock, then you have to pay capital gains tax on the growth. So that would be 15 or 20% depending upon your income. And in addition, there are some exclusions. So if it's a first-time home purchase and with depreciation with property, and then you can offset gains and losses within your investment stocks and bonds and such. So again, that's where you need to work closely with me or a tax attorney on how that ends up. So that's taxable. Third, we've got tax preferred, is what I like to call it. There are different words that people use for this, but this is an investment such as a Roth IRA, municipal bonds. Roth 401k is also an option. We've got cash value life insurance in this category. And lastly, college funds, but this is specifically for college, so such as a 529 plan. You put your money into these accounts, just like the taxable account. There's no write-off. So you put it in there, it's already been taxed. Then as it's growing, it's tax deferred, just like that tax deductible bucket. And so with the tax deferred, meaning it's growing and there are no taxes on the growth and any of the income that's generated from that as it grows. Thirdly, when you withdraw the money from these accounts, there are no taxes due. There are some nuances here. Roth IRA has specific rules with age and waiting period. College funds, specific rules, cash value life insurance. But if you're well within those rules and guidelines, it's tax-free upon the withdrawal, which is a huge benefit. And so people always wonder, well, what should I put my money in, all in the tax preferred? Well, then there are some more rules that you have to follow in order to do that. You don't get as much liquidity as you do in that taxable bucket. So, and then there's no write-off like you do in the tax deductible. So it's about having a balance between these three categories. There is another smaller type of asset class as far as taxes go, and that's annuities. And that's a hybrid mix. It's not a conversation for today, but that is another type of tax treatment. So all this to say is a big world of tax treatment of your accounts, and that's why it's so important to meet with a tax accountant and a financial advisor on strategizing. So let me know if you have any questions. You can visit my website. My email is whitney@strategic-visionaries.com, and you can call me at 612-296-6939, and that's Whitney Emanuel with Strategic Visionaries signing off.